Most traders who attempt a $100 to $500 challenge fail within 72 hours. Not because they picked bad trades. Not because the market moved against them. They fail because they treat $100 like a lottery ticket instead of treating it like $100,000. Here's the brutal truth you need to swallow right now. If you cannot respect a $2 stop loss, you will never respect a $2,000 stop loss. The math of ruin doesn't change because your account is smaller. Your psychology doesn't get easier because the numbers look insignificant. In fact, it gets harder because the temptation to gamble is highest when the stakes feel lowest. Amateur traders see $100 and think, I need 20% per trade to get there fast. This is pocket change. I can afford to be aggressive. They open their platform and immediately calculate how many trades it would take to hit $500 if they risk 10% per trade. The math looks tempting. 10 trades with 10% risk and 20% return gets you there in a week. Professional traders see $100 and think, I need to prove I can follow a process under pressure. This is my laboratory. One gambles with position size. The other tests discipline at scale. Today, we're taking this $100 live on the 1-hour chart. No hindsight editing, no cherry-picked examples, just the raw execution of what Jesse Livermore called the waiting game. Because on the 1-hour time frame, patience separates professionals from the graveyard of blown accounts. The protocol is already active. Maximum risk per trade is 2% of the account. On $100, that's exactly $2. I know what you're thinking. $2? I can't even buy coffee with that. That thought right there is the trap. Amateurs dismiss small numbers and crank up risk. Professionals know that if you can't manage $2 with discipline, you'll never manage $2,000 with it. Let me show you why this matters mathematically. When you risk 10% on a trade and it goes against you, you don't calmly accept the loss and move to the next setup. You panic. You revenge trade. You tell yourself this next one will be different. 3 losses at 10% each, and your $100 becomes $73. Your psychology is shattered. You've entered what I call the desperation zone, where every decision is contaminated by the need to make it all back immediately. Compare that to the 2% trader. After 3 losses, they still have $94. They can take 47 more trades at the same risk level before hitting zero. This gives them room to breathe, room to learn, room to let their edge play out over a sample size that actually matters. The 2% rule isn't arbitrary. It's psychological armor. We'll use what I call the 3-pillar rule throughout this challenge: patience, pyramiding, and protection. Miss any pillar, and the structure collapses. Master all 3, and small accounts become large accounts through the power of compounding controlled decisions. Patience means waiting for high probability setups instead of forcing trades because you're bored. On the 1-hour chart, this means you might wait 4 hours for a single setup. The amateur sees this as wasted time. The professional sees this as capital preservation. Every trade you don't take is a trade you can't lose. Patience is a position. Pyramiding means adding to winning positions, not losing ones. When you're right, the market tells you by moving in your favor. That's when you add more, using profits from your first position to finance the risk on your second. Amateurs do the opposite. They add to losers, hoping for reversals, and end up with massive positions at the worst possible prices. Protection means your stop loss is non-negotiable. It's not a suggestion you move when price gets close. It's the price where you admit you were wrong and exit with a controlled loss. The moment you start moving stops, you've abandoned professional trading and entered amateur gambling. But here's what most people never prepare for. The most dangerous moment in any challenge isn't when you're losing. It's when you start winning. That psychological trap has destroyed more traders than any market crash ever could. Picture this. You start with $100. You follow the rules. The account ticks up to $108, then $12, then $118. You're thinking, I've got this figured out. I'm better than I thought. Right there, your ego quietly walks over to your risk rules and starts negotiating. What if we risk 5% this time? We're playing with house money now. That phrase, house money, has no place in a professional's vocabulary. Every dollar in that account, whether it came from your pocket or from the market, is now your trading capital. It all deserves the same protection. When you let early success loosen your discipline, the market teaches you a lesson. One oversized loss wipes out 5 careful wins. Then you're not just down money, you're down confidence. The $100 to $500 challenge isn't about the money. It's about proving to yourself that you can follow a professional process when the stakes feel insignificant. Because if you can't do it with $100, you'll never do it with $100,000. The numbers change, but the psychology doesn't. The trader who respects a $2 stop loss will respect a $2,000 stop loss. The trader who waits patiently for setups on a $100 account will wait patiently on a $100,000 account. Most people watching this will never make it to $500. They'll get bored with small gains. They'll get frustrated by the waiting. They'll break their rules just to feel some excitement. But a few of you, the ones serious about this craft, will understand that we're building the foundation for a career. Right now, before the first order is placed, decide who you are going to be in this challenge. The amateur who treats $100 like a ticket to gamble, or the professional who treats $100 like training ground for serious capital. Once you choose that identity, every decision on this 1-hour chart becomes much simpler. The account is at $100. The rules are set. The market will open the next door. What happens from here depends on one thing: whether you can stick to the process when real money, even small money, is on the line. Let's begin. The 1-hour chart is open. The account is funded at exactly $100. Now the market does what it always does when you're ready to trade. It goes quiet. Then it moves in ways designed to tempt you into premature action. Price is consolidating near a clear pivotal point, a previous swing high at $1.21 that has been tested twice without breaking. You can see the battle lines forming. Some traders are positioning short, expecting a triple top failure. Others are loading up to buy any breakout, expecting an explosive move higher. The amateur sees this setup and thinks one thing: if I get in now, I'll catch the whole move. They enter immediately, buying right into the resistance, with no plan beyond hope. The professional sees the exact same chart and thinks something entirely different. Not yet. Show me proof. This distinction separates every successful trader from every blown account you'll ever encounter. Here's the brutal mathematics that most traders never learn. Hope is not a strategy, and breakouts fail approximately 60% of the time without proper confirmation. Your $100 account doesn't change this statistic. The market doesn't care about your account size. It operates by the same rules whether you're trading $100 or $100 million. Unconfirmed breakouts are traps, and they look identical to real breakouts at the moment they begin. For this first live trade, our protocol is non-negotiable. We need 3 specific conditions before risking a single dollar of this account. First, a clean break above the $1.21 level. Not just a wick poking through, but a full candle close above resistance. Second, a pullback to retest that level as support, proving that what was once a ceiling is now acting as a floor. Third, volume confirmation on the continuation move, showing that real money is stepping in to push price further, not just algorithmic noise. So we wait. This is where 90% of traders fail before they even place an order. 15 minutes pass. A 1-hour candle forms with a long upper wick touching $1.2105, but it closes back at $1.2095. An amateur might call that a breakout attempt and hit the buy button. A professional labels it correctly: rejection. The market just demonstrated that sellers still control that area. No trade. We continue waiting. Another 30 minutes crawl by. Price chops in a tight range between $1.2085 and $1.2090, going absolutely nowhere. This is psychological warfare. Your brain starts generating reasons to act. Maybe I should just get in now and catch the move before it's too late. That voice isn't intuition. It's impatience dressed up as urgency, and it has destroyed more trading accounts than any market crash in history. 45 minutes after we started watching, price finally breaks the resistance level decisively. A strong bullish candle pushes through $1.2100 and closes at $1.2115 on volume that's 40% above the recent average. Now we have step 1, the break. Amateur traders who were waiting see this and immediately hit the buy button. They think they're being disciplined by waiting for the break, but they're missing the most critical component, the retest. Price doesn't pull back immediately. It grinds higher for another candle, reaching $1.2125, adding 25 more pips above the breakout zone. Every fiber of amateur psychology is screaming, "You're missing it. Get in before it runs away." But professionals understand a fundamental truth. If this level is truly broken and flipped to support, price will return to test it. If it doesn't return, that tells us the breakout might be false momentum that won't sustain. We stick to our plan. No retest, no entry. Period. Another hour passes. You've now been watching this setup for nearly 2 hours. Your account is still at $100. You haven't made $1. This is the reality of 1-hour chart trading that nobody discusses in their highlight reels. It's boring. It's tedious. It requires the kind of patience that makes your brain itch for action. But this patience is what separates professionals from the graveyard of blown accounts. Finally, momentum starts to fade. Price begins drifting lower, pulling back toward the breakout zone. The amateur who bought the initial break is now sweating as their unrealized profit evaporates. They start bargaining with the market. "Please just go back up." Price hits $1.21 again, exactly at our former resistance level. This is the moment we've been waiting for. This is the retest. We zoom in on what the tape is actually saying. The pullback candles are small and controlled. Volume is declining as price drops, telling us sellers aren't aggressive. This is profit taking from early buyers, not a reversal. At the $1.21 level itself, a bullish engulfing pattern starts forming, completely reversing the previous red candle. Buyers stepped in exactly where they were supposed to. The market has shown its hand. Now, and only now, do we execute. Entry at $1.21, exactly at the retest of former resistance. Account size, $100. Maximum risk per trade, 2%, which equals exactly $2. We place our stop loss at $1.2060, giving the trade 40 pips of breathing room below the retest low. To risk exactly $2 with a 40 pip stop loss, our position size calculates to 0.05 lots. Target is set at $1.2180, a previous swing high where price previously stalled. We're risking $2 to make $4, maintaining our 1.12 risk-reward ratio. The order is filled. The position is live. Now comes the hardest part of trading, the part that separates professionals from everyone else, doing absolutely nothing. Amateur traders immediately start staring at the screen. Every tick up feels like validation. Every tick down feels like personal attack. They calculate their unrealized profit or loss with each pip movement. They move stops closer when price moves slightly against them, then widen them when price gets too close. This isn't analysis. It's anxiety management, and it serves no purpose except to exhaust your nervous system and tempt you into sabotaging your own plan. The professional does something radically different. We set price alerts at our target and stop levels, then physically step away from the emotional noise. The analysis is complete. The risk is defined. The edge is established. Our job now is not to manipulate the outcome, but to manage ourselves. The market operates on its own schedule, driven by forces far larger than our $100 position. 30 minutes after entry, price oscillates between $20.95 and $21.15, never quite touching our stop, never quite reaching our target. The amateur voice whispers, "Take the profit while you can. Lock in the green." But we didn't risk $2 to make 75 cents. We risked $2 to make $4, and nothing about the setup has changed to justify early exit. Another hour passes. Price continues consolidating, testing our conviction with sideways movement. This is where weak hands exit. They can't tolerate uncertainty. They take their small profit and walk away, telling themselves they traded smart. But they didn't trade smart. They traded scared. 90 minutes after our entry, the market finally tips its hand. A strong bullish candle forms, pushing through $1.2150, then $1.2165, then touching our target at $1.2180. Our limit order executes automatically. Position closed. Profit, $4. Account balance, $104. The amateur sees this result and thinks, All that waiting for $4? I could make more working minimum wage. This thought process reveals exactly why they'll never succeed. They're measuring absolute dollars instead of percentage returns and process validation. That $4 represents a 4% return on capital in a single trade with controlled risk and zero emotional damage. More importantly than the money, this trade proved something critical. Our system works under live fire. We waited 2.5 hours for proper confirmation instead of gambling on the first sign of movement. We respected our 2% risk limit without exception. We let the trade develop for 90 minutes without interference. We exited exactly where we planned to exit. The dollar amount is just feedback. The behavior is the real asset being built here. A $4 gain on $100 is 4%. If you can execute this process consistently, the compounding becomes exponential. The goal isn't to double the account in a day. The goal is to stack small, controlled edges over time without destroying capital through emotional decisions. This first trade establishes our foundation. It proves we can wait. It proves we can demand confirmation. It proves we can manage risk properly. But here's what nobody tells you about trading challenges. Winning early creates a more dangerous test than losing. Success breeds overconfidence, and overconfidence kills more traders than any market crash ever could. The account sits at $104. One trade complete, process validated. But the market will not reward us this cleanly every time. The next setup will test whether we can apply the same discipline when price doesn't cooperate so neatly. Because the real measure of a professional isn't how they handle the easy wins. It's how they respond when the market punches back. Account balance, $104. 6 hours have passed since our first trade closed successfully. This is the most dangerous moment in any small account challenge, and most traders don't even realize it. They've just tasted success. Their confidence is up. Their guard is down. They're looking at that extra $4 and thinking either I should be more conservative now or I should go bigger next time. Both thoughts will destroy them. The professional thinks something entirely different. The system worked. Apply it again. Let the market tell me when to press my advantage. The 1-hour chart has been chopping sideways for hours, forming no clear patterns, testing our ability to do the hardest thing in trading, absolutely nothing when nothing is the right action. This is the reality that gets edited out of every trading highlight reel. The waiting, the boredom, the discipline to keep capital ready without forcing it into marginal setups just because you have money burning a hole in your account. Then the structure changes. Price breaks cleanly above a consolidation zone at $1.30.50 with authority, pushing through on volume that's 40% above the recent average. This isn't a tentative probe higher. This is momentum, the kind that separates amateur scalps from professional campaigns. But here's where most small account traders make the mistake that caps their growth forever. They see this breakout and immediately calculate their maximum position size based on their full account balance. The amateur thinks, this is it. The big move I've been waiting for. I need to go all in to make this challenge work. They throw their entire risk allocation into a single trade, hoping for a home run. If they're wrong, they take a devastating psychological hit. If they're right, they have no ammunition left to capitalize when the market proves their analysis correct. They've capped their upside before the trade even develops. The professional sees the exact same breakout and thinks something completely different. This could be a campaign, not a one-shot. Start small. Let the market prove me right. Then scale into strength. That shift from one-shot thinking to campaign thinking is the DINA difference between accounts that stay small and accounts that compound exponentially. Jesse Livermore didn't build his fortune by hitting perfect entries. He built it by adding to positions that were already working, letting the market finance his increased exposure through unrealized profits. The setup meets all our criteria. Clean breakout above $1.30.50. Volume confirmation. 30 minutes later, price pulls back to retest the level at $1.30.45, forms a bullish pin bar, and starts grinding higher again. This is textbook confirmation. Break, retest, continuation. First position executed. Entry price $1.30.50. Account balance is $104, so our 2% risk equals exactly $208. Stop loss placed at $1.30.10, giving us 40 pips of breathing room below the retest low. To risk precisely $2 with a 40 pip stop loss, our position size calculates to 0.05 lots. Target set at $1.3130, an 80 pip target that maintains our 1-2 risk-reward ratio. We're risking $2.08 to potentially make $4.16. The position is live. Now we wait. But this time we're watching for something specific, evidence to add more. The amateur enters a trade and immediately starts hoping. The professional enters a trade and starts looking for confirmation to pyramid. 2 hours pass. Price doesn't shoot straight up like in the movies. It grinds higher, methodically, respecting the breakout zone, making higher lows on each minor pullback. No dramatic spikes, no scary reversals, just clean trending behavior that professionals recognize as sustainable momentum. Price reaches $1.3090. Our first position is now showing $2 of unrealized profit, exactly 20 pips into an 80 pip target. This is the critical decision point where amateur and professional traders diverge completely, and it determines whether small accounts stay small or grow exponentially. The amateur sees that $2 floating profit and their brain screams, "Take it now. Lock in the win. Don't be greedy." They exit, banking their $2 gain, and watch from the sidelines as price continues another 40 pips higher without them. They've just trained their psychology to exit winners early while letting losers run, which is the exact opposite of profitable trading. They earned 1.9% when they could have captured much more. The professional sees that same $2 unrealized profit and asks a completely different question. Is the trend still intact? We scan the chart systematically. Volume remains elevated on up moves, contracts on pullbacks. Price is holding cleanly above the $1.3050 breakout zone. The 1-hour candles continue forming higher lows. Every technical factor we used to enter the first position is still flashing green. The market is telling us we were right. This is not the time to exit. This is the time to pyramid. Here's the professional mechanics of adding to a winner. Second position executed at $1.3090. We're adding another 0.05 lots with the same 2% risk calculation, another $2.08 at risk. But here's the critical risk management adjustment that makes pyramiding safe instead of reckless. We immediately move our stop loss on the first position from $1.3010 to break even at $1.3050. Now if price reverses and takes out both positions, here's the math. First position exits at break even. Profit and loss equals 0. Second position, entered at $1.39, with stop at $1.3050, loses 40 pips or $2.08. Our total risk remains controlled at approximately 2% of the account. We haven't doubled our risk by adding the second position. We've used the market's confirmation of our first position to finance increased exposure while keeping total monetary risk unchanged. This is the art of pyramiding that amateurs never grasp. You're not gambling with bigger size. You're using the market's validation to scale into strength while the first position protects your downside. If you're wrong about the continuation, you lose only on the second entry. If you're right, you've just doubled your profit potential on a move that's already proving itself. The psychology of this moment is crucial. When you pyramid into a winning position, your brain experiences a completely different state than when you enter a fresh trade. There's no fear of being wrong because the market has already validated your analysis. There's no anxiety about timing because you're adding from a position of strength, not hope. This is what professionals mean when they talk about trading from a position of power rather than desperation. 2 more hours pass. Price continues its methodical climb. The trend structure remains intact. Higher highs, higher lows, strong closes on the hourly candles. The first position, entered at $1.3050, is now up 80 pips. The second position, entered at $1.3090, is up 40 pips. Together, they're showing $6 of unrealized profit on our $104 account. That's 5.7% unrealized gain, achieved not by taking bigger risks, but by scaling into confirmed strength. At hour 4 of this campaign, price finally reaches our target zone at $1.3130. Both limit orders execute automatically. First position profit, $4. Second position profit, $2. Total gain, $6. Account balance, $110. Let's break down what just happened mathematically, because this is where the compounding power reveals itself. Our first trade made $4 on a $100 account, a 4% return. This pyramided trade made $6 on a $104 account, a 5.7% return. But we didn't take 5.7% more risk. We took the same 2% risk per entry. The increased return came from intelligent position scaling, not from gambling with larger position sizes. Here's the lesson that separates small accounts that stay small from small accounts that grow exponentially. One well-managed pyramided trade just produced 50% more profit than our first winner. Same risk per entry. Same confirmation rules. Same discipline. But by adding to strength, rather than taking profits early, we captured significantly more of the available move. This is how professionals think about trade management. They don't ask how much can I make on this trade. They ask how can I maximize this trade if I'm right, while minimizing damage if I'm wrong. Pyramiding answers both questions. When you're right, you make substantially more. When you're wrong, you lose only on the additional entries while the base position breaks even or shows small profit. But here's the warning that nobody gives you about pyramiding, and it's more dangerous than any losing trade. When it works this cleanly, it creates psychological euphoria. Your brain releases dopamine from the winning positions and whispers seductive lies. You've figured it out. You're better than you thought. You can do this every time. This overconfidence is more lethal than any market crash, because it leads you to break your rules when the next setup appears. Pyramiding also has mechanical dangers. When it fails, it can damage your capital faster than single positions, because you're adding size as price moves in your favor. If the trend reverses sharply, those additional positions turn against you quickly. This is why the stop management is absolutely non-negotiable. You must move your initial stop to break even before adding. You must be willing to exit both positions if the trend structure breaks. You cannot fall in love with a pyramided position just because it was working. Account balance, $110. We've grown the account 10% in just 2 trade sequences. We've demonstrated that the system works under live conditions. We've proven that pyramiding can amplify returns without amplifying risk when executed with discipline. But that 10% growth is meaningless if we can't protect it when the market inevitably punches back. And it will punch back. The market doesn't reward discipline forever just because you follow rules. Every system faces the inevitable losing trade, and how you handle that loss determines whether you survive long enough to compound these gains into something significant. The next trade will test something more important than our ability to win. It will test our ability to lose correctly, to take the hit without emotional damage, to cut the loss fast and move to the next setup without revenge trading or rule violations. Because here's the brutal truth that destroys most traders: your winners don't define your character as a trader. Your losers do. The amateur panics when they lose and abandons their system. The professional proves their discipline when the market delivers its inevitable punishment. The challenge continues, but the real test is just beginning. Account balance, $110, 12 hours into the challenge. 2 successful campaigns behind us, both executed with textbook discipline. The account has grown 10% through controlled risk-taking and patient execution. This is precisely where the psychological danger reaches its peak intensity. Your brain has been rewarded twice consecutively. Neural pathways are firing, whispering seductive lies about having cracked the market's code. Every amateur trader who has ever destroyed an account has experienced exactly this sensation right before they abandoned their discipline and blew themselves up. 6 hours have passed since our pyramided winner closed. The 1-hour chart has been consolidating, offering no clear setups, testing our ability to remain patient when capital is burning a hole in our account. Then the structure changes. Price begins drifting lower, approaching a significant support zone at $1.2950. This level has been tested twice over the past week, each time producing strong bounces that sent price 80-100 pips higher. Now it's approaching for a third time, creating what technical analysts call a potential triple bottom formation. The amateur sees this setup, and their brain immediately constructs a compelling narrative. Triple bottoms are reliable reversal patterns. Everyone knows that. The level held twice before, so it has to hold again. This is practically guaranteed money. They place a limit order right at $1.2950, trying to catch the exact bottom tick, hoping to maximize their profit potential. This approach feels like smart analysis, But it's actually just pattern recognition, combined with overconfidence from recent wins. They're gambling on hope, rather than waiting for proof. The professional sees the identical chart formation and thinks something entirely different. Support zones fail approximately 40% of the time, and they look identical to successful bounces until the moment they break. Previous bounces don't guarantee future bounces. Show me proof that buyers are actually defending this level before I risk capital. The professional waits for the market to demonstrate its intentions rather than assuming them. Here's the statistical reality that destroys most small account traders. Support and resistance levels are not magical force fields where price must reverse. They're simply zones where previous buying or selling activity occurred, creating a memory in the collective trader consciousness. There's no guarantee those same participants will step in again with the same conviction, at the same price levels, with the same market conditions. Support zones fail regularly, and when they fail, they often fail decisively. For this trade, we maintain our three-part confirmation protocol with zero exceptions, despite the pressure to act quickly. First, we need clear rejection of the support zone through bullish price action. Not just price touching the level, but actual evidence that buyers are stepping in with conviction. Second, we need a break above the previous bounce high to confirm this isn't just a temporary pause before another leg down. Third, we need volume confirmation showing real accumulation rather than just algorithmic noise or brief short covering. Price approaches $29.50 and forms a textbook hammer candlestick, a single candle with a long lower wick extending down to $29.45, and a close near the high at $29.65. This represents clear rejection of lower prices. Volume on that rejection candle spikes to 35% above recent average, demonstrating that buyers stepped in with meaningful size. The following candle breaks cleanly above the previous bounce high at $29.75, confirming that the low appears to be in place. All three confirmation criteria are satisfied. The setup looks as technically sound as our previous winners. Entry executed at $29.80, catching the break above the bounce high rather than trying to pick the exact bottom. Account balance is $110, making our maximum 2% risk exactly $2.20. Stop loss is placed at $29.20, giving us 60 pips of breathing room below the hammer low. This stop placement is slightly wider than our previous trades, but the structure demands it. The support zone extends down to the $29.20 area, and we need to give the trade sufficient room to work without getting stopped out by normal market volatility. To risk precisely $2.20 with a 60 pip stop loss, our position size calculates to 0.037 lots. Target is set at $1.3050, a previous resistance zone that aligns with our 1,002 minimum risk-reward ratio. We're risking $2.20 to potentially make $5.50. The position goes live. Every rule has been followed exactly as written. The confirmation was present. The risk is controlled. The reward justifies the risk. Everything about this trade matches the technical profile of our previous winners. This is the critical point to understand. You can execute perfect process and still lose money. And that's not a flaw in your system. That's simply the nature of probability expressing itself in financial markets. For the first 20 minutes after entry, price behaves encouragingly. It pushes up to $1,300, giving us 20 pips of unrealized profit, validating our analysis and triggering the dopamine reward systems in our brain. The amateur watching this starts mentally spending money that doesn't exist yet, projecting the trade to the target and calculating their gains. They're already thinking about the next trade, about how easy this challenge is becoming, about their natural talent for reading markets. Then the tape shifts without warning. A sharp red candle appears, erasing the minor gains and slamming price back toward our entry level. The amateur's psychology immediately starts deteriorating. They're staring at the screen, watching every tick movement, mentally bargaining with the market. Just go back up. I followed all the rules. This is supposed to work. That internal dialogue isn't analysis or conviction. It's emotional attachment masquerading as professional assessment. The professional response is radically different. We zoom out and reassess the structure objectively, asking clinical questions. Is the support zone still technically intact? Yes. Price remains above $1.29. Has anything fundamental changed about our trade thesis? No. Our stop placement was calculated to give the trade room to work while limiting downside risk. If we exit now out of fear rather than evidence, we're not trading a system anymore. We're trading our emotions, which is the fastest path to account destruction. 45 minutes after entry, the market delivers its verdict with brutal efficiency. A large red candle forms without warning, breaking through $1.2960, then $1.2940, then decisively through our stop level at $1.2920. Our stop-loss order executes automatically at $1.2920. No slippage worth mentioning, no dramatic gap down, just a clean exit exactly as planned. Loss, $2.20. Account balance, $107.80. This moment separates professionals from amateurs more clearly than any winning trade ever could, and it has nothing to do with the monetary amount. It has everything to do with the internal narrative you construct about what just occurred. The amateur sees this losing trade, and their psychological framework collapses instantly. Their internal monologue becomes toxic. The system failed. Those other trades were just luck. I should have taken profit earlier on the winners. I should have seen this reversal coming. I'm not cut out for this. Each of these thoughts is psychological poison that will contaminate every future trading decision. The professional sees the exact same losing trade and constructs an entirely different narrative. The system worked perfectly. It protected my capital exactly as designed. I risked $2.20 on a setup that met all my confirmation criteria. The market moved against me, which happens regularly in probability-based endeavors. I cut the loss fast, without hesitation. I didn't move my stop hoping for a reversal. I didn't double down trying to average into a losing position. I took the hit cleanly and preserved 97.8% of my capital. This is what professional trading execution looks like. Let's examine the mathematics that the amateur's emotional brain refuses to process rationally. We risked $2.20 to potentially make $5.50, establishing a WELV 2.5 risk-reward ratio. We didn't achieve the win this time, but the setup was structurally and technically sound. If we execute 10 trades with this exact risk-reward profile and win only 4 of them, here's the mathematical outcome. 4 wins at 5.50 cents each equals $22 in profits. 6 losses at $2.20 equals $13.20 in losses. Net result, $8.80 profit across 10 trades, despite losing 60% of them. This mathematical reality destroys the amateur misconception that profitable trading requires winning most of your trades. Jesse Livermore, widely considered one of the greatest speculators in market history, won approximately 60% of his trades and still accumulated millions in profits. His edge didn't come from prediction accuracy. It came from cutting losses ruthlessly while letting winners run to their full potential. He understood that small, controlled losses are the price of admission to unlimited gains. The amateur's fatal psychological flaw is treating every loss as personal failure, evidence of inadequacy, proof they don't belong in markets. They replay losing trades obsessively, searching for the mistake they made, when often there was no mistake at all. The setup was valid. The execution was clean. The risk was controlled. The market simply moved in the other direction, which is a normal occurrence in probability-based systems. The professional's psychological edge is understanding that controlled losses validate the system, rather than undermining it. You cannot participate in significant winners without accepting that some percentage of your trades will lose. The goal is never to avoid losses entirely. The goal is to keep losses small and controlled, so they don't damage your capital base or corrupt your decision-making psychology. Here's what matters most about this losing trade. We followed every rule, without exception. We waited for 3-part confirmation, rather than hoping or guessing. We risked exactly 2% of the account, maintaining our risk management discipline. We placed our stop based on technical structure, rather than round numbers or arbitrary distances. We didn't panic when price moved against us. We didn't adjust our stop hoping for a miraculous reversal. We accepted the loss exactly as planned and exited with surgical precision. The result, 0 emotional damage, 0 rule violations, 0 temptation to revenge trade. The system held under pressure, which is infinitely more valuable than any single winning trade could ever be. Account balance, $107.80. 3 trades executed in this challenge. 2 wins generating $10 in combined profits. 1 loss costing $2.20. Net profit, $7.80, representing 7.8% account growth. Win rate, 67%. Average winner, $5. Average loser, $2.20. Risk-reward ratio, better than 2 to 1. These statistics represent the performance profile of a professional trader, not because the win rate is exceptionally high, but because the risk management is pristine and the psychology remains stable under pressure. But statistics become meaningless if you cannot control your emotional responses after inevitable losses. This is where most traders self-destruct. They absorb a losing trade and immediately feel compelled to make it back through increased aggression. They start scanning charts with desperation rather than patience. They lower their confirmation standards because they crave action. They increase position sizes to recover losses faster. Every one of these responses represents a death sentence for long-term profitability. The professional response is radically different and counterintuitive. Absorb the loss, log the trade data, analyze whether any systematic adjustment is warranted, then wait for the next high-probability setup with identical rules and identical position sizing. The loss doesn't change the process. It validates that risk management functions as designed. Here's the mental framework that keeps professionals psychologically stable after losses, that $2.20 loss wasn't money stolen from you by the market. It was the cost of testing a hypothesis under live conditions. You paid $2.20 to discover that this particular setup didn't work this time, in this market environment, with these participants. That's not expensive tuition. That's incredibly cheap compared to what you would pay if you had no stop-loss discipline and let positions run against you until panic forced catastrophic exits. The amateur sees $2.20 lost and feels financially diminished. The professional sees $2.20 lost and feels protected by proven systems. One focuses obsessively on the monetary outcome. The other focuses on process validation. That difference in psychological focus determines everything about long-term success or failure. Account balance, $107.80. The losing trade is closed and logged. The system proved it protects capital even when technically sound setups fail to develop as expected. No revenge trading occurred. No rules were broken. No psychological damage was sustained. We remain ready for the next setup whenever market conditions align with our criteria. Because here's the truth that nobody explains about professional trading. Your ability to handle winning trades is pleasant, but secondary. Your ability to handle losing trades with grace and discipline is everything. The market will deliver both outcomes regularly. The critical question is whether you'll survive the inevitable losses with your psychological discipline intact, preserving both capital and emotional stability so you can participate in the next winning opportunity. We just proved we can handle losses professionally. Now we finish this challenge with the same discipline that got us here. Account balance, $107.80. 18 hours into the challenge. We've executed 4 trades with surgical precision, 2 clean winners, 1 pyramided campaign, and 1 controlled loss that proved our risk management works under pressure. The account has grown 7.8% through disciplined execution, but this is precisely where most traders destroy everything they've built. They see progress, and their psychology shifts from disciplined professional to overconfident amateur. The brain whispers the most dangerous lie in trading: I'm up, so I can afford to take bigger risks now. This psychological trap is more lethal than any losing streak because it disguises itself as confidence when it's actually greed wearing a professional mask. The amateur thinks, I've proven the system works. I've got cushion now. What if I risk 3% on this next trade instead of 2%? Just this once. That thought feels rational. It feels like smart capital allocation. It's actually the first step toward account destruction, because once you negotiate with your risk rules, you've abandoned the foundation that created those wins. The professional sees that same $7.80 profit and thinks something entirely different. The system generated these gains by following strict rules. The moment I change those rules because I'm winning, I'm no longer trading a proven system. I'm gambling with house money, which is a myth. Every dollar in this account, whether from my initial deposit or from the market, is now my trading capital. It all deserves identical protection. 8 hours passed since our controlled loss. The 1-hour chart has been ranging without clear directional bias, testing our patience once again. This is the reality that gets edited out of highlight reels. The waiting. The discipline to preserve capital when conditions don't align with your edge. The ability to do nothing when nothing is the highest probability play available. Then structure emerges. Price breaks cleanly above a consolidation zone at $1.32, pushing through on volume that's 45% above recent average. This isn't tentative probing. This is momentum, the kind that creates multi-hour campaigns rather than quick scalps. The breakout candle closes decisively at $1.3215. 30 minutes later, price pulls back to test the breakout level, forms a bullish hammer rejection showing sellers exhausted, and begins grinding higher with renewed conviction. This is textbook Jesse Livermore tape reading. Break with volume, retest with declining volume, continuation with renewed buying pressure. Every technical element we've used throughout this challenge is flashing green simultaneously. The amateur sees this and immediately hits buy, hoping to catch the move. The professional demands complete confirmation before risking capital. Entry executed at $1.32, catching the retest of former resistance. Account balance is $107.80, making our maximum 2% risk exactly $2.16. Stop loss placed at $1.3160, giving us 40 pips of breathing room below the retest low. To risk precisely $2.16 with a 40 pip stop, our position size calculates to 0.054 lots. Target set at $1.3320, a previous swing high where price stalled during the last rally attempt. We're risking $2.16 to potentially make $6.48, maintaining better than our minimum 1-2 risk-reward ratio. 2 hours pass. Price doesn't explode vertically like in fantasy scenarios. It grinds methodically higher, making clean higher lows on each pullback, respecting the $1.32 level as support, showing sustainable momentum that professionals recognize as campaign-worthy. Price reaches $1.3280. Our first position shows $4 of unrealized profit, representing 80 pips captured toward our 120 pip target. This is where the three-pillar rule becomes absolutely critical. Pillar 1 was patience. We waited for complete confirmation rather than chasing the breakout. Pillar 2 is pyramiding. The market is validating our analysis, showing us we were right. This is confirmation to scale exposure intelligently. We scan the structure systematically. Volume remains elevated on continuation moves, contracts on pullbacks. Price holds cleanly above $1.32. The trend structure remains intact. Second position executed at $1.3280. But here's the critical professional adjustment. We immediately move our stop loss on the first position from $1.3160 to break even at $1.3200. For the second position, with an 80 pip stop distance to $1.3200, to risk exactly $2.16, our position size must be 0.027 lots. This ensures that if both positions are stopped out, our total loss remains at our 2% maximum risk threshold. This is professional pyramiding, scaling position size inversely to stop distance, maintaining constant monetary risk while increasing profit potential through multiple entries. The amateur adds the same size blindly. The professional calculates precisely based on where stops must be placed to protect the campaign. 3 more hours pass. The campaign develops exactly as technical structure suggested. Price continues its methodical climb, never violating trend structure, never threatening our stops, grinding higher with boring consistency that makes professionals wealthy while amateurs get restless and exit early, searching for excitement. At hour 5 of this campaign, price reaches our target zone at $1.3320. Both limit orders execute automatically. First position, entry $3200, exit 1 on 3320, profit $6.48. Second position, entry 3280, exit 1 on 3320, profit $1.08. Total gain, $7.56. Account balance, $115.36. We didn't hit $500, and if you're disappointed by that, you missed the entire point. This challenge was never about turning $100 into $500 in 24 hours using reckless leverage. It was about proving that professional principles work at any account size. That $7.56 gain represents a 7% return in a single trade campaign. If you can execute this process consistently, the compounding becomes exponential. 5 trades executed across 18 hours, 4 winners, 1 controlled loss. Total return, 15.36%. Win rate, 80%, but that's secondary. Risk management, pristine across every trade. Position sizing, calculated precisely to maintain 2% maximum risk. Stop discipline, 0 violations. This is professional execution stripped of marketing hype. Here's what matters. If you can execute this process on $100, you can execute it on $100,000. The principles don't scale, only position size does. Cut losses fast. Size positions small. Wait for confirmation. Pyramid into strength. Protect capital above all else. These aren't tips you apply when convenient. These are the non-negotiable foundations of every trader who has compounded small accounts into generational wealth. The challenge continues beyond this video, because real trading isn't a highlight reel. It's a career built on thousands of decisions under pressure. Your ability to follow process when winning determines whether you keep gains. Your ability to follow process when losing determines whether you survive to participate in the next campaign. If this resonated, if you recognized yourself in the amateur behaviors we contrasted, if you're serious about building real skill rather than chasing quick money, the next lesson will show you how to identify these setups on any time frame. Because knowing when to trade is as critical as knowing how to trade.